Welcome back, everyone, to What the FICC. I am Spencer Israel. That's Ian Cully, head of fixed income, currencies, and commodities at All Star Charts. Mr. Cully, what's doing?
Tapping and Spencer.
Same old, same old. You and I did the morning show this morning. You did a great job, but we did an even better job of not giving away the juice of today's show, right? Today's What the FICC. So we've been talking about doing this for a few weeks now. We frequently get questions during the course of this show about a variety of topics, and we always plan out our shows ahead of time. And so what we thought we would do is just solicit questions and do an entire show based on those questions. So we're not going to talk about any one specific topic. Usually we pick a theme, right? It could be oil or currencies or metals or whatever, or softs, grains. Today the theme is your questions. So we have a few questions that have been sent to us. If you have a question and you're watching right now and you want to email us, you can do so. Questions@stockmarketmedia.com, or just put your question in the chat. And even if we don't have the chart, we'll do our best to answer it on the spot. That being said, Ian, should we start with some of the questions we've gotten over the past couple of weeks?
Sounds good. Let's go.
All right. This was a question from Thabo. Is it Thabo or Thabo? I think it's Thabo. It's about the crack spread, which is what every time we talk about oil, you talk about the crack spread. So the question really is, what is the crack spread, and how does the gap work in terms of interest on the margins for the likes of a bunch of oil and gas companies, right?
So the crack spread is basically the gross processing margins for oil refiners. The reason I like to track the crack spread, and here this first chart is the what they call the 3-2-1 crack spread, which is looking at the spread between three contracts or 3 barrels of oil versus gasoline, 2 barrels of gasoline and 1 barrel of heating oil. It gives a good idea of underlying demand for crude oil. So when the spread is widening, when the line on this chart is moving higher, the price of gasoline and heating oil or diesel is outpacing the rise in crude oil prices. Oftentimes, when we see a widening in this spread, crude oil tends to catch up. Now, the opposite is true when the spread begins to tighten. When demand begins to dwindle for the distillates, crude oil distillates, crude oil then ultimately usually begins to fall lower. And that's what we've been seeing. Another way to look at it here is to look at crude oil with heating oil and gasoline futures side by side.
So this is just another way of looking at the crack spread. This is just the crack spread in different visual form.
Exactly. Yeah. So we're not actually looking at the spread itself, but we're looking at the individual contracts. And you see that the rise in heating oil and the gasoline pressing up against critical areas of resistance, led to the breakout in crude oil futures. Crude oil played catch up, it broke out. The fact that heating oil and gasoline didn't follow through has led to crude oil pulling back and retesting that breakout level around 83.25. This is where crude oil is now, chopping between 93 and 83. And I imagine it will continue to stay within that range as long as this crack spread remains tight. If and when the spread's back above 24, 25, when it's back above the shelf of former highs here, I'm not really worried about the level so much. Just getting back above this shelf of former highs and just widening. Begins to widen again. That's what I imagine we're going to see crude oil making its way back up to 93 and then breaking higher potentially in that $100 roll. Maybe make it all the way up to 115, but I doubt that's happening unless gasoline's digging in, unless heating oil is catching higher. And what's interesting is if we're not seeing these contracts begin to perform, begin to gain, we're most likely not going to see energy stocks breaking out. And that's what's so wild, as well as energy has been doing. Is you know, the rally that we've seen in crude oil this year, or last quarter, and the rally we've seen in individual oil services names, even some of the explorers and producers and the midstreams are starting to look good as well. XLE hasn't even broken out yet. Now this is a shorter term chart, but we could zoom out on a weekly chart, and there's a big resistance level up here around 95, 100, 105 area.
I'm sorry. Can we go back to the crack spread for a second?
Yeah, sure.
So if we think of, and if we can bring the chart up on the screen, if we think of the price of oil as one of the major fundamental drivers of oil and gas companies, right? Then can we think of the crack spread as one of the major fundamental drivers of the price of oil?
Yes. 100%, exactly, and that's why I pay attention to it, of course. Yeah.
Okay.
So as it widens, there's increased underlying demand for crude oil. That's how I look at it.
So as the line goes up on this chart, there's more demand for oil. Because why? Because it's cheap compared to the cost of gasoline and heating oil? Or
it's not because it's cheap compared to the price of gasoline and heating oil. It's because the prices of gasoline and heating oil are rising because of increased demand. So as the demand increases for the distillates, for the products, for crude oil byproducts, then the demand for crude oil itself increases, and therefore the price goes higher.
Okay. And what about when it's falling like it has been? So when the crack spread's falling, what does that indicate?
Well, I'm sorry?
When the crack spread is falling.
That's it's not constructive for higher prices for crude oil, and that's what we've seen. Crude oil has been pulling back and consolidating just below, or excuse me, just above a former resistance level that is now turned into support around 83. So this is principal polarity 101, former resistance becoming support. Want to see the crack spread begin to widen a little bit in order for crude to dig in here and hold this 83 level. Gasoline's trying. We're seeing a little bit of an uptick here in the crack spread. Nothing significant.
But what I'm getting
still,
at is,
yeah,
the crack spread's falling because there is less demand for crude oil.
Less demand for the distillates.
Less demand. So really what this is a measure of is demand for the heating oil and gasoline, because
that's how I view it. Absolutely.
Because you get those from crude oil.
Right. So if there's a large spread between the price of crude oil and it widens, and the distillates are asking for a premium, then crude oil tends to pick up, and that's when you see this crack spread begin to tighten and fall over, right? And to tend to roll over to the downside, which we've seen over the past month or so. That's as crude oil prices catch up to heating oil and gasoline, and then as crude oil remains elevated and demand dwindles for heating oil and gasoline, it continues to tighten, and that's basically what we're seeing here. But it's a thing. If this crack spread needs to continue to widen, if we're going to see a breakout in XLE, it needs to widen if we're going to see a breakout in crack. and the Van Eck oil refiners ETF and all these oil refining names, because this is the processing margins. This is directly relates to their profits, their profit margins. So, if we're going to see crack above 36 and a half, ripping up towards 50, then I imagine this crack spread is widening. This crack spread is widening, and crude oil is probably catching up to that line. Same thing for oil services. If XLE and crack, they're all going to be going together in tandem. And we've seen the oil services has definitely led the way, the strongest industry group within energy. But I mean, I want to see broad participation across the space, and that's not happening if the spread continues to tighten. So definitely keeping my eyes on that. I think it's a great question, and it's definitely something I recommend everyone track for sure.
So just to put a bow on this, how does the crack spread sort of impact the margins for the oil refiners? Like a rising crack spread versus a falling crack spread, and their costs.
Oh yeah, so a rising crack spread, a widening crack spread is great for their profit margins. It increases their profit margins. So what they're having to buy crude for versus what they're able to sell the refined products is beneficial for oil refiners, 100%.
And likewise, a falling crack spread means they aren't able to get as much bang for their buck with the oil that they have when they sell it to be refined into gasoline or heating oil.
Exactly. That's it.
Okay. Yep. All right. Cool. All right. I hope that answered your question, Thabo. Let's move on here to a question from Les. He is interested in your take on foreign bonds and or fixed income for emerging markets, and then he specifically highlighted South Africa. I want to increase my exposure in that area, as I think I own a lot of stocks, but want to extend my exposure on this side of the market. All right, so from oil and gas and crack spreads to emerging market bonds, that's a hell of a segue there, Ian. So what are your thoughts on this corner of the market?
I honestly don't look at a lot of individual emerging market bonds. Well, but I wanted to go ahead and bring the South African 10-year yield and just take a look at the past 30 years or so, 25 years. And I don't like, I see a big base. And I see yields rising steadily over the past almost 10 years, past decade. And, definitely not an area of the market that I want to buy. Like I'm still not crazy about buying bonds. I think we're in a rising rate environment. And it's not one of the areas of the market that I recommend getting long or overweighting. If you wanted to carry some bonds in your portfolio, definitely I would underweight bonds, whether we're talking about U.S. treasuries or South African treasuries. And one of the reasons, bonds just keep falling. Ooh. Now here's the emerging markets bond ETF EMB. Now this is a basket of 604 different bonds here, large basket, but keep falling again. As long as EMB's below its 2020 low, around 85, I don't think there's much to do here from a buying perspective. See what happens around 78.
Do you have any idea what the yield is on this thing? I'm trying to think of a reason to own it. Right.
I can let you know here in just one moment.
Because even prior to, last year, right? I would certainly hope the yield was attractive because that's the only reason to own this thing. So I'm not really sure, um, you know, if it's not, I'm not really sure why you would ever want to own this ETF.
Yes, the yield is pretty attractive.
Well, there you go. All right. So
Um,
it's got that going for it, but
it's got,
I
yeah, I mean, it's got that going for it. I, you know, I don't look at these assets for their yield necessarily.
what do you look
I'm
at them
more
for?
interested in price, and I just don't want to own anything, especially bonds that continue to just fall apart. Um, what I do like to do with this emerging market bond ETF, just emerging markets bonds in general, is to compare them to U.S. bonds. I think it's more of like an international credit spreads. The way I look at
Yeah,
this,
that's interesting.
this is a risk on risk off ratio for me, and it's interesting to see that it bottomed, and it looks constructive. It looks constructive. And here's the emerging bar, the EMB IEF ratio overlaid with the S&P 500, and you could see heading into the end of 2021, we were getting a divergence here. We were getting a series of lower highs in this ratio as the S&P 500 continued towards its peak, and then both rolled over. On the flip side, as the S&P 500 made its way into its October low last year, this ratio, this risk on risk off ratio, was putting in a higher low. A bullish divergence that ultimately led to fresh 52-week highs for both. So it's interesting to see that this ratio is hanging in there. It's remaining buoyant as the S&P 500 presses towards fresh lows. So I'm keeping an eye on emerging market bonds versus U.S. Treasuries as a risk on gauge in terms of the bond market. And a fresh high or a higher low would be very constructive for the S&P 500 for U.S. equities in general.
All right. Next question.
I like to see something like that. A higher high, excuse me, a higher low in this risk on ratio, kind of support the action we're seeing in Bitcoin. That would make me feel a lot better about Bitcoin ripping in terms of its relationship to potential rally in stocks.
All right. So really the bottom line here is you wouldn't own emerging market bonds, but you do like what they're telling you, at least compared to US bonds at the moment.
Yeah, and since bonds just in general are a dumpster fire, right? They're a dumpster fire. So if you are owning these things simply for the yield and you're not worried about price depreciation, buy emerging market bonds.
Yeah.
I think that's what I'm seeing here, and it's if investors continue to move in that direction, charts are revealing that stocks are most likely heading in the same direction.
All right, let's move on here. We had a question more broadly about just intermarket correlations between the markets that you look at. So maybe you could just kind of go through what the main just historical long-term correlations and relationships that you look at.
Yeah, I threw some together. Stocks and gold. Everyone seems to be pretty interested in gold right now, especially because gold has been catching higher. It's a seasonally strong period for gold futures. It's kind of this is a 40-week correlation study here in the lower pane here, and you can see it's a toss up. It's a toss up. You know, we have periods of strong positive correlations, and then we some periods of extreme negative correlations as well. I think a lot of those strong negative correlations are, at least back in 2008, you had that flight to safety in gold, while stocks historic sell off. Now, it's interesting. Stocks, the S&P 500 remaining buoyant, and gold has remained buoyant. So we get a positive correlation right now. It's not very strong at the moment, but it's a little bit of a wash here. And this is a great example of the adage that correlations come and they go. You always got to trade what's in front of you. That's really, really important. Price is king. Now here's stocks, the S&P 500 overlaid with the 30-year T-bond. Strong negative correlation between these risk assets and treasury bonds, range from 07 to 2014. Kind of, it's gone back and forth. I think last year was, really was a major outlier in that, bonds had a historic sell-off, and equity sold off as well. There's really nowhere to hide. Bonds continue to sell off. Equities are holding up. So it's, it'll be interesting to see if this negative correlation kicks back in, and bonds just remain lower as we start to get a bid here in risk assets. And paying attention to that. And then this is the strongest, I think, relationship, and that's crude oil and bonds. And this is interesting. This is, crude oil does well in a rising rate environment. Bonds, that's the whole fixed income part of, or the fixed part of the fixed income scenario here. As rates rise, the price of those bonds fall. No way getting around that. So yeah, crude oil enjoys this environment, bonds don't, and they're negative, strong negative correlation.
Wow.
And then we take that one step further and then put gold next to bonds, and you see how gold tends to follow the bonds, and I think it has more to do with interest rates than anything else.
And these are kind of your favorite intermarket relationships to look at, right?
Yeah, I mean, I look at a lot of intermarket relationships.
Okay.
These are just some big ones that I've gotten some questions about in the past month or so, especially in terms of gold and crude oil, and how to play these two I guess opposing commodities during a rising rate environment. Like, can gold actually catch a bid and break to new all-time highs as rates rise? I think it can. It absolutely can. It's gonna have a problem with a stronger dollar and an explosive rally in rates like we've seen. I think it's more, it's kind of like equities and bonds. It just needs, it needs less bond market volatility. Gold needs less bond market volatility, I think, to do well.
All right. Were there any more? Because we had a couple more questions to get to.
Yes. Yeah, we got.
All right. We had a question just sent to us just now from Jonathan regarding silver.
Yes.
So let me see if I can get this. We are near extreme. Silver looks extremely historically undervalued against the Dow Jones index. So Jonathan would love a long-term view on silver if you have one.
Oh, I've got one.
Okay. I figured you would, which is why I asked.
Just a moment.
And then we got a couple more in the chat, so we'll probably go a little long today, and that's all right.
Yeah,
that's the beauty of YouTube. We can go as short or as long as we want.
Let's see here. Yeah, I like the look of silver right now. With the way real yields in the dollar are looking right now, I think precious metals have more work to do. But there's a couple really long-term charts here for silver. A few silver charts. Wow, man, Spencer, you should have seen all the silver charts I had back in 2020. Oh my gosh. So many silver charts during that rally. It was insane. I had VWAPs off of every other.
And then January 21 was when it became a meme, right? I believe so.
I remember that pop. Yeah.
I'm sure you do.
You know it.
I'm sure you do.
I'm just gonna share a bunch of my silver charts here. That 2140 level, it's a big level. It's a really big level for silver. Let's see if I can find this one here.
And if you can't, that's okay. But let's just bring a chart up on the screen. Do we have one? There we go. Okay.
Yeah, we got one. Yeah.
All right, so this is not that long-term chart. This only goes back a couple of years, but then let's see if we can maybe get a longer-term one. There you go. All right. And this goes back to the 1970s. Or no, does that go back to the 60s? Like that might go back to the 60s.
It goes back to the early 70s.
Early 70s? Okay.
I don't remember when we're able to trade silver. I know gold, it wasn't until the late 60s until you could actually legally trade gold. Let me find this other silver chart. It highlights a polarity zone around 2140, which is a key level that silver reclaimed recently. It looks like it's carving out a potential inverted head and shoulders. I mean, we'll see. Again, I think these commodities, these assets, need more time. I'm not ready to get behind silver with any major conviction. But it's constructive. It's constructive to see the action. Here we go. This is the one. This highlights that 2142 level polarity zone going back to that 2008 high. Also acted as a major inflection point in 2016. Turned into support. Here we can zoom in. Let's see here. Too many of the same chart. Turned into support. Monthly candlestick. Maybe acting as support for the better half of the last couple years since 2020. Broke down below that level and quickly bounced higher earlier in the month. 2220 is my level in the continuation chart. For the December contract, it's up around 2280. Then it's pulling back to that level today. Again, I think we got some more work to do in the precious metal space. Again, not quite ready to get all bulled up, but there are levels to trade against. And when these things go, I mean, they're going to go. Silver decisively breaks above 26. I think 35 could be just like 2020 all over again, ripping back up to that major level.
All right, let's do a couple more here from Jeff. Question about natty gas. Is UNG a good way to express a bullish thesis on natural gas? Is it
Yes.
a good representation of the front month contract?
Yes.
There we go.
100%. I like UNG.
Excellent.
I like UNG.
Great.
If you want to get the juice, I would use the options market for UNG.
Okay. Okay, good. And then the last one that we'll do for Yako. Yako's asking about a couple physical gold ETFs. AAAU versus IAU. Does it I guess you're asking, does it are they different? No, they are the same. I'm not quite sure what you're asking. I guess he's asking holding a physical backed gold ETF or not holding it, or versus a gold ETF that doesn't hold gold. I'm not really quite sure what the question here is actually. AAAU and IAU are pretty much the same. One is a lot more liquid than the other. IAU has a lot more volume, a lot more liquidity, a lot more assets. It is a little bit more expensive to own, just from the expense ratio standpoint, but they both hold physical gold, and they both track the same gold index. So they are basically the same thing. So I guess he's asking, Ian, do you have an opinion on if you want to go long gold on owning a physical gold-backed ETF versus just, GDX or the gold miners, for example?
It depends on if you're looking for a pure play on gold. If you're looking for a pure play on gold, then definitely you want one of the physically backed ETFs, something like GLD even, GLD or IAU. I'm not familiar with AAAU.
Honestly, I wasn't either until just now.
Yeah, I was. Yeah, but it's obviously it's Goldman Sachs, so I'm sure it's I'm sure it's a great ETF. But yeah, there's going to be more risk involved. I would imagine more volatility in one of the mining ETFs like GDX. So yeah, I would definitely. I like it. I like trading GLD 100%. I think we have GLD and IAU both in our weekly deck on Mondays.
Yep.
Maybe about AAU. Like that.
And then for Jeff, do you use technicals on UNG? Or
yeah, 100%. I use technicals on absolutely anything. You could chart any time series, chart baseball card prices, and I can use technicals on that. Any kind of time series, 100%. Yes.
All right.
You want to? I'm sure I got a chart of UNG somewhere.
That's all right. All right. I think this was really good. Good that we did this. We get questions pretty frequently, and we don't usually answer questions during the show because Ian and I, we usually powwow about what we want to talk about ahead of time, and so we can have charts ready for it. But this was good. We should definitely do this again. If you have any questions about anything as it pertains to commodities, gold, silver, wheat, corn, metals, hard, softs, currencies, bonds, anything, email us. You can email us at the email that's on the bottom of the screen, questions@stockmarketmedia.com. You can always reach out to Ian on Twitter. If you want Ian's research, the best way to do that, you can go to his blog, the link to which is in the description below this video on YouTube. You can also sign up and become a member of All-Star Charts Premium. That's where Ian publishes more of his research, and you get actually access to exclusive decks, slide decks, charts, other weekly videos that he's doing that are not accessed to the public, and you get sort of the full access behind the curtain, so to speak, with that subscription. And that's what I got. Anything else? Any final thoughts?
It's Monday. Excuse me, is it Monday? It's Wednesday. I don't even know what day of the week it is. It's hump day. We're halfway there. We're halfway there.
We're halfway there.
Markets are messy. Tread lightly and manage risk. It's really the game plan.
All right, we'll catch you guys next time. Thanks for watching What's the FICC.
Thanks for watching.